we started this fund with the idea from a fintech side, let's create something new for the marketplace. So we wake up every morning and we say, let's be a better VC every day. And then let's create innovations that open up the marketplace to go after all these people that aren't investing in venture capital or innovation because they don't have access. That thing two for us is access. How do we, and you said it, we lower the minimum, that's one step. Take participation rates, make them more visible. Educate them in the same way that a GP, the venture fund would talk to itself. Let's take that information and let's keep getting it to our investors so that they're better educated about it. And so we'll do more. But what we're trying to do is change that environment. And then if we do that well, more people will provide capital, we'll be able to grow the firm, we'll be able to grow, and that's a skin in the game. Let's prove it to everybody. And so we have lowered the minimums, so your clients can come in at $25,000, $50,000 levels. We like people to think about a 3% of net worth allocation. So invest $50,000 in a diversified set. 2 out of 10 will mature. When they mature, maybe put in $10,000, $20,000 into those individual deals once they've been de-risked a bit. So that, if you're the 3% of your net, if you're a $2 million, $3 million net worth person, that you're thinking about 2 or 3% of your investment. If you're further away from retirement, you're a young person, you're 40 years old, stick it in your IRA, think about $100,000, $200,000 allocated to this and have it keep sort of pecking away at the venture side. And it, after 20 years, that turns into a nice chunk. We're getting a realignment of everybody up the vertical. The industry is incredibly efficient. So ADM and Bunge and Cargill and all these farmers, they've all got everything lined up to really bring down the cost of food. And we've done that over the last 40, 50 years. Monsanto's focused on yield. So we used to, on computer processors, we used to care about processor speed. Like I remember, got to get that process a little faster. Now I don't think anybody bases it on processor speed. They buy it based on how long it will run on its battery. It's changed our philosophy on your paradigm shift. So what's happening in food, we spent 40, 50 years optimizing food for yield to feed the world and really end starvation by bringing price down. Now we're saying it's not just yield, it's food and nutrition. It's not just food and nutrition, it's mom and dad at the grocery store looking at the label, not looking at calories, but looking at the micronutrients.
Right.
So what's starting to happen is we built this entire supply chain to optimize on commodity grains. And now what's happening is mom and dad are saying, I'm worried about some additional things. So that retail pressure of I need to know more is coming in. And what does that mean? That means, in a sense, you have to connect what's going on the farm through the entire supply chain that's currently a commodity supply chain.
Okay.
And now you need to connect it with all the information. So this is what's happening. And then we've got companies like Grower's Edge that's coming in and saying, hey, Mr. Farmer, you're trying to adopt this new technology. I'll give you asset-based lending that reduces your risk, and I'll help you speed up your process of adopting new technology. And then we've got companies like McCarris that says, hey, the CBOE has got to now figure out, I'm not just selling yellow corn at 3, yellow corn 3 to go into this, but I've got a specialty protein that has some other qualities, and I've got a label associated with it. And so you've got a whole bunch of things going on in that data stream that are coming online, and other providers building themselves around the genetics. So on the genetics side, we're focused on not yield, but yield, taste, and nutrition, so that we build higher quality food. And then the other smart kids are coming in and they're building other things around that system. So we spend a lot of time. We really think of ourselves not in the investment business, but the information business.
Right.
And we invest to get the information. And then we create optionality in our investments. So that's the other people like Y Combinator and Hyde Park Angels and have said, hey, if you invest in 50, 60 early stage companies broadly, it will pay off.
Right.
Well, it pays off in three ways. Okay. One, you get a return because you've diversified your investment. So, okay, there'll be two of those will really take off. Two, you get information. You learn stuff that other people don't know. I mean, how many things have you picked up in that space and gone out to dinner with somebody else and started telling about it? And they're like, I had no idea.
Yeah.
And three, you get an option. You get optionality. When you have those participation rights,
right.
2 out of those 10 companies are going to take off. And, I had Madugliano as a professor at MIT. The whole original portfolio theory, balance, diversification. They also taught options there. And if you've made a diversified investment early on, and 2 out of 10 of those have sort of struggled their way through, and 2 out of 10 are really moving ahead, to know that, hey, this is pre-IPO and it's moving well above the J curve and it's really performing, that's an interesting time to start talking about non-diversified investment. Because you've been paying attention to the company for 3 years, you've seen their quarterly reports, you've talked to people, that's a point in time where you have what a GP and a venture fund has, which is a huge asymmetric advantage in information. On the healthcare side, we've been taught for years that better health is monitoring calories. It's not. You can be fat healthy, you can be thin unhealthy, and that is metabolic health. So we're starting to learn that certainly people know about being diabetic.
Right.
And then they're starting to know about being pre-diabetic. Well,
right.
The best researchers are actually saying the damage occurs before you're pre-diabetic. You're metabolically unhealthy. And that you do that for a period of time. So what we're starting to see is the ag genetics people are now taking their product, putting it in humans and animals, and seeing what is the metabolic effect on insulin, and really looking at what you absorb rather than what they think you absorb. And so these people are working very hard at tying that all together. And over the next 20 years from now, it'll all be blatantly blinding flash of the obvious. But right now, all of those companies are lining up and doing new things that investors, once we get past this innovation phase,
right,
we're out of innovation as an asset class, and we're in the, hey, I want to hold equity, stocks, and bonds.